What's up, guys? Jay Martin here, investor and CEO of Cambridge House, and my guest today is Lyn Alden, the founder of Lyn Alden Investment Strategies. I love having Lyn on at least once per quarter to determine where she is allocating her cash. So I hope you enjoy this as much as I did. Now, 3 things before we jump into this interview. Number 1, if you're not a newsletter subscriber, join now. There's a pinned comment right beneath this video. You can join for free. I publish every week and I love writing it. Number 2, when I launched this YouTube channel, I did not anticipate generating advertising revenue, but coincidentally, I do now, which is awesome. And so what I've decided to do with this cash is donate it to an organization that is super close to my heart called Zero Ceiling. Zero Ceiling's mission is to end youth homelessness. The way they do that is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness locations, providing supportive housing, employment training, life skills, and exposure to the natural world, wild places. I'm somebody who is massively transformed and a massive benefactor of my experiences in wilderness and wild places. So I love being able to pay this forward. Zero Ceiling's awesome. Go check them out. Number 3, if you prefer to listen to my content instead of watch it, you can now find us wherever you listen to your podcast. Just search The Jay Martin Show. Okay, here's Lyn Alden. Enjoy.
What I love to do is introduce the right people to the right people. I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
2 questions I have pulling off of that. Number 1, do you think the end of the eviction moratorium could counter your rent inflation and housing price inflation to any noticeable degree, or is it not an important bullet point?
So I would say the end of the moratorium should be positive for rent prices. And so part of why they're not going up is because if you can't evict people, it affects your pricing power. And so what we've seen is early signs. We're already seeing, if you look at the data, it's not just theoretical. We're already seeing an uptick in rent prices. So the question is how big or how persistent it will get. Generally, you see, the biggest increases are in people that have changed locations. So if you have new tenants coming in, that's when you raise your prices quite a bit. And so we've been seeing jumps there. Another thing is that the rent moratorium, if you look at the percentage of people paying rent, it's actually not that different from, say, 2019, right? So we have this conception where, half of people are not paying their rent. And that kind of overstates what's happening. There's actually a pretty small percentage that are really making use of those rent moratoriums. Okay. And so I would say it has a somewhat smaller effect, but because the marginal pricing can affect the whole thing, basically if landlords know that if push comes to shove, they had trouble evicting their tenants, they might be less aggressive at trying to raise their rents across the board, even for paying tenants. But so I do think that as that comes off, that should be pro rent price. Now, on the other side of it, the unemployment benefits wearing off, that could put a little bit downward pressure on this labor shortage we've been having. So right. That'd be kind of the anti-wage increase theory that this is primarily like a temporary thing. It's only held up because the incentives have been messed up for the past year and a half. And so when that wears off, employees will have more leverage. And I think that's certainly a variable to watch out for. So I'm actually really curious to see what happens with some of these jobs numbers in Q4 and then say first quarter of next year. But I do think that the more likely case is that there is some structural labor shortage here for a period of time, because we're changing a lot of things in the economy, and we've had pretty significant inflation in most categories outside of, say, software, electronics, apparel, things that are easily reproducible, and people are basically demanding higher wages in order to, go to work for periods of time. 100%.
And all that supports what you said. You expect inflation, but not in a straight line. Rising inflation, but not in a straight line. So stepping back then, corrections aside, we continue to see rising inflation, at a super basic level. That means if you're holding cash, you're hurt. If you're holding assets, you win. Generally speaking, it's the wealthy who have the assets and the poor who are holding cash. So with an increase in inflation, we can only expect any wealth gap to increase as well. And the rise of populism trend that we've been seeing over the last decade in the US, you could expect that to accelerate as well. And do you watch that trend as well? Do you watch the impacts of civil unrest and populism and the way politicians respond to it, and factor that into your investment theses at all, Lyn?
So that wealth concentration is another framework that I've watched to some extent, because you generally have these long stretches where, politics favors labor for a long period of time until it gets kind of excessive, and they start to get so much political power that it becomes untenable. And then someone comes in and there's enough political pushback that they break that up and kind of swing the pendulum in the other direction. Then you get to the point of like crony capitalism, where you have like a corporations have all the power, labor's been crushed, people get populist against that, and someone comes in and busts that up and pushes the pendulum back in their direction. That's kind of been that's been like an age-old thing in history. As far as inflation, who inflation benefits or hurts, it's actually really, there's a lot of variables in there. And so the unintuitive thing that you wouldn't expect is, so if you look at the two inflationary decades of last century, the 40s and the 70s, wealth concentration went down during those inflationary periods. And it's complicated because, so in the 40s, you had very, very high tax rates on the wealthy. And in the 70s, you had very, very high union membership, things like that. Okay. Another complicating factor is, so the rich hold more diverse assets, including inflation adjusting assets. But if you look at, say, how much assets they have compared to how much leverage they have very, very little leverage compared to assets.
Interesting.
If you look at people on the bottom 90%, especially the bottom 50%, they have like half as much leverage as they have assets. They're very leverage heavy.
Yes.
And so actually in an inflationary environment, a lot of that leverage is fixed rate. A lot of it is, gets basically partially inflated away.
Yeah.
And so if you have, say, a fixed mortgage on your house and you're middle class, you're quite short the dollar in that sense. You're long a hard asset and you're short the dollar for a very big chunk of your net worth.
Right.
And so it's kind of complex, because if, say, you're a retiree on fixed income and you're not particularly well off, then you're hurt by that, right? So unless you happen to hold major inflation hedges on the side. And so it's really complex. There's multiple variables there: assets, liabilities, whether or not your assets are inflation adjusting. And so there are people from both the poor camp and the rich camp and the middle camp that will benefit or be harmed by this, partially based on how well they invest through it, partially based on the reasons for the inflation, right? So in the 40s, you had this, it's almost like they did MMT in the 40s. They printed a ton of money. They built all these factories. They hired a bunch of people. When the soldiers came home from war, they sent like 8 million of them to college and training programs and things like that. And so that was inflationary, but it was mostly screwing over the wealthy bondholders with high tax rates and devaluing their bonds, and then shoving that into the middle class. That's partially what they had. And so in this environment, we've had higher prices, higher grocery prices, but also, for example, wealthy people don't get stimulus checks. The poor people, say the 90% of the population does. I shouldn't say poor people, the majority of the population.
Yeah.
But the wealthy people have still benefited from the asset prices going up, because we've had an unusually strong stock market, housing market. And so this has kind of been that rare environment where most people have kind of pushed up in some way in nominal terms. And we have to worry about the hangover maybe going out a couple of years, because we're already starting to see that economic data is decelerating, right? So we had this strong year of growth after the key lockdown periods back in the spring of 2020.
Yeah.
And so now with fiscal stimulus wearing off, and with base effects harder, and with kind of the peak probably behind us, we're decelerating now to some extent, while we still have some of those inflationary pressures. So we risk kind of this somewhat more stagflationary environment, and it's really worth kind of watching out for that. So that could start kind of separating winners from losers a little bit more.
Interesting. Okay, so can we talk about your portfolio a little bit and how you've built your wealth picture? And at as high of a level as you want to, can you talk to me about your distribution through hard assets, maybe real estate, gold, alternative assets, equities? How do you organize your wealth, Lyn?
So I've had a very big exposure to equities, for this whole period. And that, a combination, I use some indices, but I prefer to identify sectors or companies that I think have a reasonable valuation, because I know I can look at them. I know what their cash flows are. Obviously you always have variability in the future, but it's easy to kind of feel comfortable in investment when you know when you can do a model on it and say what you think it's worth versus just owning a line that goes up and down and represents like 500 companies, you actually want to look through them and kind of know what's going on there. And so I have a variety of equity exposures, both in the United States and globally. Right, so it's geographically diverse. It's diverse by sectors, but it is tilted towards certain areas. And so, for example, I've been pretty bullish on energy at these kind of beaten down prices. For example, I like some of the lower cost, lower leverage producers, right? So I like to hold investments for years. So I'm not really kind of swinging for the fences with the most leveraged speculative ones. I prefer the kind of the longer term compounders. Yep. Same thing for some of the higher quality midstream companies. I like some of the healthcare companies. And then there are certain tech companies that, despite being very expensive, I've been long because I think that they're kind of long-term winners, right? So for example, there are people saying the FANG stocks were overvalued 5, 6, 7 years ago, and then they doubled or tripled from there because they had real kind of fundamental growth behind them. And so there are a handful of tech stocks that I cover like that. And so I have that. You could kind of say it's, you take the 60-40 portfolio, but then you take out a bunch of the bonds and you put in precious metals. You put in some additional equity exposure, but carefully selected. Okay. I've also been pretty heavily long Bitcoin since April 2020 as part of that portfolio slice as well. Right.
Now, can you talk to me about what specifically you look for in the healthcare sector? And the only reason I ask is because that's a sector that's super interesting to me. I am always looking for opportunities in maybe more health science, but it's like a personal passion and a big piece of my portfolio. 2 conversations I had this week, David Rubenstein, Mark Yusko, both called out healthcare as their industry they're most excited about. Anything specific in healthcare catching your attention right now?
So one thing is, if you look at, people often describe growth versus value stocks, but you can separate value stocks into, say, cyclical value and defensive value. And those tend to perform very differently in different environments. And so healthcare would fall more into that defensive value if you're talking about, say, the larger types of companies versus the smaller like biotechs. Sure. And so because, there's, even though my coverage is pretty broad, there are certain areas that I don't cover almost at all, which is, say, small biotechs. It's just not, I have zero edge there. Yeah. So that'd be an area where if I were to add some of that to my portfolio, I would follow a professional, like a medical analyst or something like that, and take tips from there. And so what I do is I sort through some of the larger or mid cap ones that have these diversified business lines, and say, if I think the economy is decelerating, I look into these and I say, well, these they have their own risks, but they're the business cycle is not really one of them. You can say. Mm-hmm. And so I kind of tilt into those if I expect the business cycle to turn lower, defensive value space, kind of like how people would treat utilities. But sometimes you can get better valuations with some of those. So I look for why, I analyze the strength of their portfolio, their pipeline going out several years. I look at their valuation, I look at their balance sheet, and so I kind of just some of the health insurers, even if they're oversold, underloved. So I kind of pick through some of the mid to large cap value space if I'm not feeling particularly bullish about some of the more cyclical prospects in the economy for a period of time.
Okay. Thanks for that. Now, I know you've been long Bitcoin since probably our first conversation, if not sooner, as you said, April 2020. The way I've started to think about crypto or digital currencies are like into 3 buckets. You've got your maybe traditional cryptocurrencies like Bitcoin and now thousands of others, but everybody knows Bitcoin and Ethereum. And then you've got your central bank issued digital currencies, which are probably have arrived in some countries. And then maybe if there's a third box, you could call it your Silicon Valley based cryptocurrencies. And the one that we all know about is Libra. And this is like the tech giants. When are they going to start creating with aggression their own currencies? Now, I'm really curious about that third box, and I don't know if you've got any thoughts on it, but you look at a company like Amazon, right? It's obviously in the conversation in the boardrooms. There's obviously plans and whatnot, and with the right execution, we all could live 100% of our lives inside of the Amazon ecosystem, right? All the food, supplies, goods, services we need could be found right there and purchased with the Amazon currency. Do you see anything interesting over there, Lyn, or does anything catch your attention or have any thoughts?
To a certain extent. And so, I think it is important to think about central bank digital currencies and then there's private versions.
Yeah. Okay.
And so one thing to separate is when we look at something like China, they've been researching this topic since like 2014, and they've been testing it for a few years now. And so they're almost at the deployment stage for their central bank digital currency. And to some extent, that's because just like in business, if you're the incumbent, you have less incentive to disrupt yourself. Right, it's the hungry newcomer that wants to do something different. So China wants to be able to buy commodities in their own currency. They want to surveil their citizens as much as they can. Unfortunately, they want to go around the SWIFT system. They have a bunch of incentives that really, when they saw the technology, they're like, wait a second, we can really use this. And so they were quick on that. And so they're ahead of the curve there. The Federal Reserve is the king of the current system. And so they've been not aggressive at looking into central bank digital currencies like some of those other ones have. And so if they want to move forward now, I think in the West probably we're looking at least for a period of time more reliant on those private stablecoin type of entities, because the Federal Reserve would take probably years to deploy something. If they start from scratch. Right. And so, Facebook's Libra was an early attempt. They wanted to make essentially a Bancor or like an SDR, like a basket of major currencies, but issued by this private entity. And that regulators didn't really like that. So that kind of got halted. And then they resurrected that as DM, which is, more like separate stable coins. They'd have a dollar stable coin, then they might separately have a euro stable coin. And so they, from their perspective, they want to have their own wallet. They want to have this ecosystem, and basically they want to kind of displace the banking system to some extent. So stable coins are very efficient for anyone who's kind of worked with a digitally native business or use stable coins. They can be far more effective than, say, wire transfers. You can send a stable coin payment internationally at 2 a.m. on a Sunday, and it settles in a few minutes. And no, you didn't have to ask permission. Now, regulators still like stablecoins more than something like Bitcoin, as long as they have control of it, because, for example, stablecoin issuer can blacklist certain addresses. And so it's not a fully decentralized system like, say, Bitcoin is, where it's unstoppable pretty much. And so, but for the most part, if you were kind of, not on some blacklist, you're using this fairly permissionless, decentralized thing, and you're going around banking hours, and you can go international. And so obviously regulators are trying to get a handle on that and figure out what that means and what kind of systemic issues it can have. And banks are, I think, somewhat worried about that sort of thing as well. But those are the advantages of that stablecoin technology. And so I think in the West, probably going to see, those projects launch, but with heavy regulation. So they want to make sure that they're holding pristine collateral. None of they're not exactly thrilled with the offshore ones that we don't know what they hold for sure or how much they hold. They want to have these entities that are holding it. If the stable coin's backed by dollars, they want it to be backed by dollars and T-bills that are audited well, right? So I think that's the type of thing we're going to see. So we're seeing UDS DC, for example, Circle. That's kind of the more regulated stablecoin, you could say, a little bit more above board than something like Tether. Gemini has also had a very regulated stablecoin. They've kind of stuck to the pristine collateral approach. Facebook clearly wants to orientate themselves around that direction as well. The difference being that so far, the primary usage for stablecoins has been speculating in crypto markets, right? So they bring the stablecoins to an offshore exchange. They use it as a unit of account to trade Bitcoin, Ethereum, and these other tokens. Whereas Facebook wants to make that more of like a peer-to-peer payment system. They want to use stablecoins more for that purpose. Now, there are businesses that that are kind of early that have been using stable coins, and it's like if you talk to them, once they start doing that, they never want to go back, right? Because no one wants to send like a 3-day wire transfer, then you lose track of it. You're trying to argue with your bank, and you get told no. They just want to be able to they want to be able to send that payment 2 a.m. on a Sunday if they want to, and so that's spreading, but it hasn't really gotten too far into consumer finance yet. And so that's where Facebook wants to go after. And if you look at their new white paper, their second version, their DM, not the Libra, but the DM, they reference central bank digital currencies. They kind of view themselves as potentially working with central bank digital currencies as an overlay, as an extension. So, for example, their reserves could be central bank digital currencies. They could be Fed coins, for example, and that this would be like a tech layer over that has more features than the Fed could do on their own. Right. And so that's kind of a big question going forward, is how fast is this ecosystem going to develop and what direction it's going to take. But I think that's kind of one way to think about it. And then we monitor it and see if we see a change in direction.
Now, okay, thank you for that. Now, when I have a lot of the guests I have on this show, we talk about central bank issued digital currencies, and things get pretty exciting. We sort of walk down that path about what the future could look like and all of this stuff. It's very easy to go down a dystopian path, right? I mean, you talked about a lot of the benefits, convenience, right? Able to send a wire at 2 a.m. on a Sunday and have no delay or authentication required, or I guess approval required, third-party approval. It's also easy to walk down the dystopian path and say, central bank issued digital currencies are really a surveillance tool that also function as a currency. That's what they really are. But let me ask you, Lyn, when you walk down that path, like in your mind, do you get excited? Do you get nervous? Both? Do you see it as more utopian future, dystopian future? How do you react?
So both. I mean, obviously in China, we have the more dystopian version of, the surveillance coin that's like linked to a social credit score.
It's horrifying to agree.
Very horrifying. It basically gives the state tremendous power.
Yeah.
The ideal future is that you don't phase out cash or private transactions while you add this for people that want to use them. And so, for example, if you're sending a wire transfer, you're already getting surveilled anyway at that point. Yeah. And so stable coin transfers are just way better when you're already operating inside of a surveilled system. It's just better. It's basically technology applied to multi-decade-old systems, and it's just a better version of the same thing. And so really that's just better. But the risk is if they try to phase out cash, and so that's where you can get, for example, locked into negative rate type of environments because you can't withdraw to cash, and it makes it so that they can surveil every transaction. Whereas cash has always been the most private type of interaction. So people have often been concerned about cryptocurrencies and their use in crime. Criminals actually prefer cash because that's really the most private type of transaction. Mm-hmm. But not everybody, it's privacy is not the same as criminality. So plenty of people just want to have privacy with their transactions, and I strongly support that they should be able to do that. They should have an option to do that. And so in a world where cash still exists, in a world where something like Bitcoin exists, which is like pseudo-private, can't be stopped, can't be told no. So I like those types of bearer assets, those private or semi-private bearer assets, alongside stable coins to replace some of the clunky parts of our financial system. So the risk is that this technology does give policymakers a lot of tools, many of which negative, with China being an obvious example. And I would hope that people push back and kind of advocate for privacy. We've seen some kind of infringements on privacy in countries around the world over the past year or so, and technology just makes that easier and easier for them to do. So I think there are kind of dystopian risks, and one doesn't have to think very hard because we literally see China already doing it, and we see other countries kind of flirting with some authoritarian policies.
What other countries, Lyn? What other countries come to mind?
Well, I mean, that's I was talking about like broadly. Like you could say, for example, mandates around vaccines or certain things. I don't want to get political with stuff like that, but basically, we certainly have controversial things that are happening. Yeah. That when you start linking it to technology, that basically one way to control things is through the money system, right? So if you can shut off people's access to money, if you can automatically debit their account, if you can surveil every transaction, obviously a state has more power. And if it's a benign state, then you might not get negative consequences from that right away or for a long period of time. But if that state deviates in any way, like say China has, they're more prone to use that against the populace.
Interesting. Yeah. Okay. I'm with you. Okay. Now, in the fall of 2020, I had you on the show and I asked you, Lyn, if you had $100,000 and all I wanted you to do with it was speculate, and your time horizon was 5 years, and I was asking you for the most exciting speculation over a 5-year time horizon, your answer at that point was Bitcoin. And If I ask you the same question today, do you have the same answer or a different answer?
So, I mean, with a 5-year time horizon, I still think Bitcoin is one of the best risk rewards out there. I consider it, below the risk of speculation, in the sense that it's not like a Hail Mary. Like, I'm not like it's not something without fundamentals. It's something that I consider safer than some of my other investments, for example. But I do still think it has one of the highest return potentials. I think the uranium space offers another avenue for pretty large gains. So I think that the Bitcoin and the uranium space, if someone wants to get riskier, they can go into, say, altcoins or something like that. But those, statistically have a very, very poor track record over a 5-year period. Whereas with Bitcoin, it's kind of like you can be very volatile in the near term, but so far, at least, and this might not continue in the future, but so far, no one's ever held Bitcoin for 4 years and not been up, right? So there's been periods where they've held it for 2 years and they're down, maybe 2.5 years, but in every 4-year period, Bitcoin is considerably higher. And so whereas the altcoins kind of have the opposite problem, where they have really explosive gains, but generally over long periods of time, they tend to degrade, except for so far out of the thousands, there have been a handful that have held on for more than one cycle. And so, there are spaces like that one can speculate in. But I think things like Bitcoin and uranium and spaces like that kind of provide considerable upside with less downside risk.
Okay, I love that. In the same question, you have $100,000, your time horizon is 5 years, but your only goal is to protect purchasing power. Where do you look in that scenario right now?
That's the biggest challenge. So my only answer for that would be diversification. Okay. So it'd be things like equities, gold, Bitcoin, even as a percentage.
Sure.
A bunch of different assets. Your home, your like real estate, to basically not bet on any one thing, and to just be in a lot of real assets. And then maybe some, for example, even though I don't particularly like cash, I don't particularly like bonds, I would have a non-zero amount of, say, tips, for example, because if you do get a risk-off environment, you could rebalance that. So I still like some liquidity in there to kind of take advantage of kind of maybe risk-off moments that happen. So there's really no single asset that I would say I just want to put this in 5 years and make sure I don't lose it. Because obviously, if I was measuring in dollar terms, it'd be dollars or T-bills. But the purchasing power of that is likely to go down. It'd be some combination of real assets, essentially. Got
it. Okay. Lyn, thanks so much for coming back on. I appreciate it. Yeah, I appreciate your time. I appreciate your perspective. You're a crowd favorite on my channel, so thanks again.
Happy to. Thanks for having me.
Okay guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. But coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational, and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The J Martin Show.